Welcome to this Times Techies webinar. I'm Sujit John, and I have with me my colleague Shilpa Fadnis. The two of us will moderate the discussion. We hope you and your families are staying safe and doing well. Our discussion today is on machine learning innovations in finance, and it's in association with Synechron. Synechron is a New York-based IT and consulting company focused on the financial services industry, including capital markets, insurance, and banking. India has seen some great innovations in finance. UPI is seen as path-breaking. Financial technology startups are all the rage right now, and we have one with us today on our panel. AI and ML have already helped create some fascinating solutions for the industry. A lot more are in the works. To talk about this potential, we have with us three seasoned professionals. We have with us Uday Chaudhary. Uday is Senior Director of Technology at Synechron India. Uday has been in the IT industry for over 21 years, of which more than 15 years have been in the financial services and banking domain. He's an expert on blockchain, digital asset management, innovation, and machine learning, and leads Synechron's blockchain initiatives and projects. Uday has been with Synechron for more than 11 years. Welcome, Uday.
We have Ananta Sharma.
Thank you for having me.
We have Ananta Sharma. Ananta is the Director of Technology at Synechron UK. He has 17 years of experience and deep expertise in innovation, IoT, data analytics, and big data. In the 7 years he's been with Synechron, he has led the innovation practice, built POCs, accelerators, solutions in the BFSI domain. He has published multiple research papers on NLP, differential privacy, classification techniques. Welcome, Ananta.
Thank you.
And we have Vijay Agarwal. Vijay is the CTO of BharatPe. BharatPe makes it easy for all of us to make payments. The company is a unicorn valued at almost $3 billion. It made big news in the last few months when it handed out BMW bikes to new joinees. Vijay has over 13 years of experience in the internet industry, all with high energy startups. He's worked across functions, including engineering, products, marketing. Welcome, Vijay.
Thanks, Shilpa.
Those of you who are viewing this can send in questions through the Facebook comment box. Sujit and I will put them to Vijay, Ananta, and Uday. Coming to you first, Ananta, banking and financial services is a very regulated industry. Does this make AI, ML solutions for this industry very different from that of the others?
Yes, it does, because the regulated nature of the industry requires the models and the solutions that are built to be explainable. So the idea of explainability in these models limits the kind of technique that can be employed in these kinds of to address the problems. So mostly banks would rely or focus on statistical models rather than something like a deep learning model or something else, because deep learning models are inherently not easily explainable, although there is a lot of inroads being done right now to make sure that deep learning models are also as explainable as any run-of-the-mill statistical models. So these are the kind of things that kind of limits them. This would also kind of play a role in the way those models are constructed and the technologies that are used in constructing those models and the kind of data, availability of the data and the data engineering activity itself. So there are a lot of aspects to it. And those are the things that kind of make a big difference between what a bank would be able to do and what another company would be able to do.
Sure. Uday, do you want to add to what Ananta said?
Yeah, I completely second what Ananta said, but you know, machine learning models are like completely opaque models. And they are like a black box in a business, and you know, it's very risky to use this black box. So explainable AI definitely gives a lot of value implementing it. With the limitation, it's only can be implemented to the statistical models. But you know, if I want to elaborate more about what is explainable AI, so it happens that you know the explainable AI algorithms can give you the reasons for the prediction and the recommendations. The feature attribution is what explainable AI does, and you know, it indicates how much each feature in your model is contributed to the prediction of each of the given instances. and it's like a game where each player can be identified, that what is the contribution of that player for the winning and losing of that particular game. And it helps us to explain what is model doing behind the scenes and how the prediction is happening on the scripts. And this plays very vital role when we are talking about a regulated industry where compliance and regulations are asking for an explanation about each and every steps happening in financial industry. But though it's a regulated model for the financial industry, I would say that the implementation strategy plays very important role because every financial industry is talking about AI, but not necessarily everyone has a right implementation strategy for implementing the machine learning. So having the right platforms, having the right infrastructure, having the right model setup, working towards the life cycle of those models, and maintaining those models along the lane, doing onto the production, is very important. When we are strictly into regulated industry, because you need to generate a lot of reports for your predictions. And on a high level, when I see the machine learning implementation, it happens in two ways. One, I call it as a narrow AI, where we use the prediction and recommendation models. And second, I call it as an assistant intelligence, where you can use the statistical models to derive an alternative scores, and this scores can help you to do the operational efficiency in your business functions. So when you're regulated industry, going from a second route would be more preferable by the banks and financial industries. That's what we have seen with our experience.
Vijay, you want to add to that?
Yeah. So explainability is one key aspect that we've discussed. Another key aspect is, data security and data protection is important everywhere, but it is even more important in a regulated industry like finance or fintech, right? So we have to be very, very careful about what kind of data we are processing and how we are safeguarding that data. It is not a feature of AI ML per se, but we need to be very careful of this aspect also.
Okay, so give us some interesting kinds of AI ML solutions that all of you are developing. Who wants to start? Something really interesting. Vijay, why don't you? Something interesting that you've done.
Sure. So we use AI and ML all through the application and solution lifecycle, right from customer acquisition to retention and servicing the customer if something goes wrong, to even predicting the loads on our systems and scaling them up or down accordingly. So AI and ML find their application in all walks of software engineering now. So much so that when it comes to internal team structuring, I would say 5 years back, the thought used to be you have a dedicated data team, right, alongside your application team. These days, it is more and more every application team has to be enabled by data engineering and data science skills, right? So it is not a separate department or a separate team anymore. You need those skills in every software engineering team you have, whatever solution they are developing, right? So we use a lot of intelligence when it comes to processing transactions, right? When we do settlements, we make the payments to the merchants. We want to make sure that the payment happens as fast and as seamlessly as possible. And behind the scenes, there's a lot of complex routing happening, from which bank account do we initiate the payment, to which bank account do we have to make the payment. So there's a lot of dynamic decisioning happening there. And over there, we deploy an ML model which selects the best combination, depending on the success rate that we are seeing at that point in time, and the historical understanding that we've developed. So a lot of intelligent routing is happening there when it comes to settlements, fraud detection and prevention. That is another application, right? For every transaction that is happening on our system on a real-time basis, do we allow that transaction? Do we block that transaction? right? Do we block a user account temporarily on the suspicion that maybe somebody has got access to a user's device and they are doing some fraudulent activities? So to safeguard our merchant, to safeguard a customer, we do take those calls intelligently from time to time, and without hampering the user experience also as far as possible. So we have to strike the best balance between convenience and security. Right? Both of them are very, very important at the end of the day. Then we have applications in underwriting, right? which is the main revenue source we've got as a business, right? So when we give loans, how much is the risk associated with every loan? What should be the tenure that we should offer? What should be the amount of loan, the size of the loan that we should offer? What should be the other terms? Like there are a lot of variables that we analyze there from the historical payment data that the merchant has on our platform. And over there, we've got a very good advantage in the sense that we've got a real-time view of the business that the merchant is doing, right? Which puts us in a very, very good spot with respect to underwriting. And if you look at the traditional way of doing things, underwriting would happen by way of looking at certain documents, like looking at the income tax statements, looking at profit and loss statements, looking at tax returns, right? Whereas we've got a much more relevant data, which is the real-time view of the transactions that the merchant is doing on their shop, right? So that puts us in a very good position. Then we need to deploy like good AI and ML algorithms to make sense of that data, to process that volume and come up with intelligent recommendations. Right? We use it for cross-selling and upselling as well. Like we as a business, we offer multiple products and solutions to our merchants. Like we give them payment solutions, both QR and POS machines. Like we do a lot of other products as well. So throughout their journey on our platform, from time to time, we get a sense of, okay, what product our merchants are using, what else can they use to like further grow their business, right? And to make the right recommendations at the right point in time. That is something we do. Right? Regarding loans, there are lots of things. When do we generate messages or alerts to merchants, right, at the right point in time? If, like, for example, if the merchant has missed an installment, right, is it because of a genuine reason? For example, because of a lockdown, the shop was not operational, right? Then it is not a merchant's fault, and like we won't bother the merchant. But it has happened a few times while the shop is open, the merchant is doing transaction. So we analyze a lot of that data, right? And if something goes wrong with the merchant, calls up the call center, then the person who is sitting on the other, they have real-time access to a lot of relevant data of the merchant, so that they can quickly understand the problem the merchant is facing and come up with the right resolution in a very short span of time. Right? So all these aspects involve AI and ML, and like I said, like there is hardly any aspect of software engineering today which is not like AI and ML.
Many amazing, fascinating. Uday, Anand, tell me, I mean, you deal with the large banks. Are they using it as extensively as some of these fintechs?
Absolutely. As per our experience, we have seen machine learning and artificial intelligence almost each and every step of financial transactions. But if I want to pick any two most important one or recent one which we are working for our big clients, so I'll pick the credit risk assessment. As Vijay also mentioned about the credit risk assessment in the payments world here, credit risk assessment, the solution that empowers the banks to proactively manage their credit portfolios. These portfolios can be mortgages or auto loans or credit card loans or business loans. Here we ingest the historical loans and repayment data, pull in the macroeconomic parameters, the news data, and the borrower's data. And the system uses all machine learning models, including random forest and clustering and neural networks to predict the credit defaults, the delinquencies, and prepayments. It really enables banks to drill down the factors that drive the likeliness of the credit events to proactively manage the individual risk, and they can rank it by their probability. and eventually bank can offer the products and deals to their customers to reduce their risk of non-repayment of any loans. So this was one of the very beautiful. I personally like this use case a lot. But on the same line, we also spoke about automation of underwriting. So we have also implemented for one of our larger insurance companies, automating their underwriting processes. So when you talk about underwriting, so in case of insurance, it leads to identifying the premiums, doing the due diligence and assessing the risk of the requesting party. Goal is to provision the underwriter with all the alternative and required information for the case. So he can focus on the risk assessment and reduce the delay of the underwriting process, which in turn increases the binding ratio for the insurance company and their probability of winning the business. So here the data points are gathered from the credit score agencies and additional insights regarding business operations and risk exposures information. This helps to calculate the indicative score. We call it as a win score versus a risk score. And this score is generated with a statistical analysis and some predictive modeling methods, which is refined by their behavioral analytics of the customer. And early detection of such type of risky deals, reduces the opportunity cost for the underwriters and, helps them prioritize the underwriting and focus more on their valuable deals. But having these two use cases, we have also seen a lot of traction in a wealth technology domain for improving the client lifecycle management for asset management area, starting from smart and quick client onboarding, automated client onboarding, to automating the client prospecting and identifying their high value deals. We have also seen a lot of exposure towards treasury, global treasury and multinational treasury, where they need to maintain the liquidity and balances across their multiple accounts, and they have to deal with all the data securities to make sure that their accounts are well liquidated for their local expenses of that particular region. And this we extensively use artificial intelligence and machine learning models to identify the right liquidity required for that particular account, and then even can trigger to fill in those accounts dynamically, so that banks can save on their penalties for non-performance of the liquidity management.
How are these solutions working? How well, Anant, how well are these solutions working? Banks, others are seeing clear gains?
Yeah, so these solutions have multiple roles to play. One is to assist or aid in the normal functioning of their business, day-to-day operations and business, like BAU, business as usual. So these solutions do a great job in helping the banks continue. So for instance, if you take any bank, on a given day, they will have hundreds or even thousands of loan applications. They'll have to go through each one of them, start processing them, and so on. And every month, a bank would have hundreds of thousands of loans, and you will have to predict the payments that are happening. And if somebody misses their payment, you need to start predicting. So that starts up a whole bunch of other processes. There needs to be a bunch of systems that will need to deal with that, predict, is this a late payment, or is the person who's going to miss their payment, and what is the impact of that, and so on. There is also regulatory requirements for the banks to report to the feds, detailing how much loss they're expecting because of lack of payment or for whatever other reason. So economic conditions and all will need to be taken into account in building these things. So the banks use these models quite extensively. The problem comes in effectiveness. When you want to make a model more effective, you need to have data from a whole gamut of places. And that's where the bank, so you take any bank for that matter, they will have tons of data about a customer, from their transactional behavior to their loan prepayment and repayment behavior, to how much salary that they're taking home, what their income sources are. So all this information gives the bank a very clear understanding or a very clear picture of who the customer is and what capabilities that customer brings to the table, and or what financial capabilities that customer has. So the problem that banks kind of face is mainly about bringing all of this data together and in a structured and sensible manner while maintaining privacy protections for the customer, because there are conditions like GDPR and CCCP and so on. All of these expect the banks to protect the customer data, not just from outsiders, also from within the organization, because you don't want a different department to kind of be able to target a specific customer. Not to mean somebody's doing it, but you want to prevent that possibility from the get-go. And these are the kind of things where the banks are currently focused on, and that's what we help them with. The engineering part of it, the ability to move the data in the right format and the right structure and the right speeds in order to assist in each one of these activities. If you take fraud detection for that matter, you'll really need to know if a customer has business. Let's say if somebody is sending money from the US to India or India to US. You really need to know if the customer has previously had financial engagements with that address or with that entity. To do that, you need to have data coming in from, let's say, different accounts or different sections or different products that the customer currently deals with, be it savings accounts, checking account, could be their credit cards, could be any of it. But so these individual systems are usually run as silos. So your credit system or your loan application or loan division is a silo which doesn't really have much visibility into, let's say, the credit card product versus your commercial banking or your personal banking, that is your savings account and your checking account and other products. So we're trying to help banks build synergies between these lines of businesses in order to make their existing models more effective. And when you build these synergies, there is obviously an influx of a huge amount of data that's coming in. And that would also require re-engineering of some of their existing practices. And even process re-engineering would also need to take place, not just data re-engineering. So a whole bunch of those activities, those are the things that we kind of help our banks with, help our clients with in achieving them. So there are multiple techniques that we employ, like differential privacy, and so differential privacy is kind of the mainstay there. There is also concepts around federated learning, which helps the banks sort of keep the data local. So in order to be compliant with some of these privacy regulations and still be able to extract insights from that data and pass them across different lines of businesses or different divisions and still be able to make the most of that data. So banks usually struggle with this portion of activity, which to make their models more efficient and more effective than what they currently are.
Vijay, same question. I mean, impact. I mean, can you give some metrics, something that you benefited from because of these solutions?
Yeah. I mean, at the end of the day, everything, every step we take, every improvement we intend to do has to have a quantifiable metric associated with it, with which we can measure. And as it was alluded to previously in the discussion, like explainability is also very important, and inherently these algorithms tend to be so complex that it is difficult to make sense of what is going under the hoods, right? So it is all the more important to take a hard look at the output and benchmark it against what would have otherwise been the case, and how much is my output better, because there is no other way really to feel confident of the effectiveness of the thing we're doing, right? And over there we look at what are the ultimate business outcomes that we intend to get, like depending on the situation. For example, if you're talking of customer support, right, the time to resolve a ticket is the ultimate metric, right? So how much time reduction that we achieved, it could be through any means. It could be by way of giving out meaningful information to the service agent. It could be by way of making the right suggestions in terms of resolutions. It could be through some other means. But the ultimate metric is how much time reduction we achieved, right? Another metric is sorry, how much cross sell was successful, right? If we suggested a new product or service to the merchant, how many times did we make a suggestion and how many times was the suggestion taken up within a due period of time. In terms of frauds we talk about, so I mean that is again very easy to measure, how many frauds have happened, what is the volume of frauds in terms of number of transactions, amount of money, right? In terms of underwriting, it is about how much of NPAs are we having from time to time, right? And also the leading indicator, like how many installments are due past their due date, right? How many bills are pending to be cleared. So all of these are matrices that we take.
Most fintech NPAs are quite low, isn't it? I mean,
yeah, thanks to these algorithms, thanks to the data-driven decisioning. The underwriting is where I think we have the most impact of data and ML compared to the traditional setup.
And routing, you mentioned what? It just intelligent routing, it speeds up everything, is it?
It speeds up everything, reduces problems like the money was debited from one account but was not deposited into another account. So like got stuck somewhere in between, those kind of problems.
Okay.
And like I mean, we look at transactions. The whole thing of like UPI providing a real-time ability to do transactions is all possible because of modern technology, right? Otherwise, I mean, we've all seen days where like it used to take days, not even hours, to transfer money from one bank account to other bank account.
Shilpa?
Yeah, Ananta, banks operate in a very highly regulated environment. If you can talk about what are the challenges in implementing ML in a production environment?
Yeah, yeah, I think this kind of fits right in with what Vijay was talking about, productionizing models. How do you figure out a model is efficient? How do you figure out a model is sort of effective in what it's doing? These are the kind of problems that banks deal with. Of course, the data side is obviously there. So they deal with petabytes of data that needs to get churned for a model to get trained. And when it goes to production, that model probably has maybe like a month's life before it gets displaced with a new model. So which means that there is this cycle of a new model getting trained and built, constructed, and productionized every month almost, because the conditions with which the model was trained will change in about a month's time, but that model is no longer effective. So to understand this, there is a technique called champion challenger model, where you deploy your production model and you also deploy a challenger model. So you build a model using techniques that are non-standard and deploy, let's say, an explainable model and a not, well, say explainable per se model together. And while these two models were being constructed, they kind of pairs, they get developed together. And as part of your testing and validation and verification process, you kind of realize what should be the parity between A and B, let's say the champion and the challenger. You would say the champion and challenger are usually, let's say, 0.2% off from each other. So if the champion says, whatever it could be, let's say it's supposed to predict a score and it predicts 0.8, and the challenger will predict 0.84 or 0.076 or something else. So you understand what those gaps are, and both these models will go to production. And only one model's data is actually being used by whatever system is invoking it. So the champion model is the only one's data that is being used. But you have a whole bunch of infrastructure behind the scenes, which compares what the champion model is doing and what the challenger model is doing at the same time. So it tries to identify what these tolerances are and these configurations against each one of these systems. And you would track and see how quickly is your champion model deteriorating, because your challenger model is more robust to handle these things, but you can't use their predictions in production because it's not explainable. So you would have a challenger model and a champion model, and you have a model monitoring infrastructure, which will constantly keep track of how quickly is your champion model deteriorating. And based on that, you will then decide, should you displace your champion model with something else? So at that point, even the challenger model will be displaced because the second pair of models would go to production. So these are the kind of things that the banks currently deal with. This are the problems that that they want a more consistent solution for. So this is where MLOps and DevSecOps kind of come into play. Model operations and DevOps activities for models, MLOps. And so we actually helped one of our clients build a platform where you start from model construction to model verification and validation to all the approvals and the whole process it takes till the model goes to production. And in production, the champion and challenger model construct is built, and the monitoring infrastructure is also built around it, so that you will the system will be able to kind of do a prediction saying that, okay, the way things are going, maybe in another week your champion model will be useless. Not useless, but will be off enough that it will lose its effectiveness. And so at that point, you will have to make provisions to displace that model with something else. And that is a continuous cycle. You take a model to production, you are already working on the next model that will replace it. So that's usually how the whole cycle goes. And at this point, each time you're building a new model or you're constructing a new model, you have new data, because that last 1 month worth of data that has come through is being considered. You also try to analyze the economic situations. For instance, when COVID hit, all the predictions that all the economic scenarios and all the predictions that people had went out the window. They had to start from the beginning. So you had to create these economic stress conditions that need to go into those models. Usually when these models are built, we have about 20 or 30 different stress scenarios that we test the model against to see how it will work when, let's say, the interest rate is higher, lower, the economy is under stress and not under stress, and so on. So all of those things had to be redone. And something similar kind of happens each time a model is constructed again. So at that point, we try to determine if new data elements or new dimensions need to be included in that model. So do you want to include, let's say, a certain type of demographic customers, or you might notice that there is a customers of a specific what should I say, demographic are more inclined to look for loans within your bank, in which case you will tune your model to handle those kind of requests more accurately, so to speak. So at that time, you also have to make sure that your model is not biased, because you're tuning your model so much that if you end up over tuning it, your model will become biased, and that is a huge problem. You want to stay away from it, and that is the kind of situations that the bank wants to kind of. It's a fine line that you have to kind of tread very, very carefully. You want to have a very good model, but at the same time, it should not be biased and a whole bunch of stuff. These are the kind of problems that banks deal with. Although they have machine learning and AI and a whole bunch of stuff, their problem is mainly around applying all of these together in such a way that it's in the framework of what is acceptable by the law and what's beneficial for their business and things.
Okay. Already questions coming in from the audience. Let me, all of you kind of mentioned this, but let me nonetheless put this. You can have a slightly, if there's anything more you want to add to it. This is around, again, frauds. Kumar Samyak asking, how can we detect and stop frauds in finance with the help of ML? Is it even possible? I mean, of course, frauds, everybody is now saying, especially with all this digital transformation, a lot of frauds. I'm sure the financial sector is seeing equally large number of frauds or attempts at frauds. To what extent, Uday, Vijay, to what extent has AI/ML helped to identify these and contain them? Uday, you want to start?
Yeah, so frauds definitely, I believe that, we can definitely work on frauds, because, whenever fraudulent behavior happens, it's like odd man out behavior, which can be identified by a lot of clustering and neural network algorithms. But, we have seen some of the black swan events, which are very difficult to identify, and which needs a lot of validations. Every time transaction goes in, it has to run down to a lot of validations to make sure that this is a legitimate transaction. And if similar type of transaction keep on occurring for multiple frequencies, then we can identify that this is some sort of a fishy transaction which can be marked and highlighted as a fraud, or marked and highlighted for a special consideration for monitoring purpose. I think this is the way we can arrive from. So we cannot eliminate fraud, but we can definitely reduce the losses happening through the fraudulent behavior.
But which are the dangerous ones? Which are the ones that are still getting in, kind of still managing to attack without the system detecting it?
Small transactions. We have usually seen that the transactions which are smaller value, and if these transactions are happening at particular frequency or higher frequency and particular time, it's very easy to identify those transactions as a fraudulent transactions, because technically a normal human individual do not do small transactions very often. So these are type of transactions which can be easily identified. But identifying the fraudulent transactions and going through an AML checks, it's like a big world out there. I'm sure Vijay will put more focus on that.
Yeah, Vijay, you want to?
Yeah, so as they already mentioned a few things, I'd say that the whole aspect of fraud prevention can broadly be broken down into two phases. One is authentication, which frankly speaking is outside the purview of AI and ML. I mean, authentication is simply like you put in the right checks. For example, whether you require a two-factor authentication. Right? There can be rules around like beyond a certain amount, or there can be the rules. Like these are not machine learning rules. These are simple authentication mechanisms, right? To make sure that the chances of someone else doing a transaction on someone else's behalf, the chances of that get minimized. But unfortunately, in the real world, we see it all that often, like, and especially with mobile devices, it is very easy, like the device theft and identity theft and all those things happen. And that's where we come to the second aspect. Right? But unfortunately here, we can't really do much about questioning the authenticity of the transaction when we have to assume that it is authentic in the sense that it has been authorized. All we can do is we can look for anomalies, right? Is it unusual? Then that is the question we can ask, and then we can take a decision on whether to let the transaction through or not. Right? And for anomaly detection, we look at various parameters, like what is the amount of transaction vis-a-vis the other transactions that the user has done. Right? Time of day is another factor. Right? Is it usual for the user concerned to do a transaction at this time? Right? The frequency of transaction, like too many transactions happening at very short intervals, like is this usual or unusual? So we can look at all those things, and this is where AI and ML come into the picture, and that helps us flag off certain transactions or certain behavior, and basis that we can take certain actions to hopefully safeguard the user from monetary losses. And this is where AI and ML come into the picture, and a lot of it is I would say falls into, like, what would say, it is different, right? And which is where we've seen like sometimes we get calls from the banks, sir, we're calling to confirm whether you've done this transaction or not, right? Which is where the system has flagged a certain transaction, right? And it could be a very legitimate transaction as well, but since it is unusual, like there needs to be a mechanism, whether automated or involving a human, to double check whether the transaction should be led through or not.
Yeah, that's true. I think the banks call up, especially when I do a big transaction, suddenly, sometimes it's automated, sometimes a human thing, but it does come.
Yeah.
But a lot of small transactions may escape, and that I think that's what Uday was trying to say. Was it? A lot of small transactions might escape this, is it?
Yes, small transactions might escape this because those are legitimate transactions. But if these are happening with higher frequencies in a small interval of time, that is definitely a point of concern which can be raised.
Okay.
And many times, whenever transaction happens, it's not ideally possible to validate each and everything of the transaction, because we need to match up the delay, and we need to settle the transaction as soon as possible. But we can just match up with if this transaction, such type of transactions happening again and again, then we can raise our validation a bit to see that if the merchant is a legitimate merchant, if that merchant address is registered, which is a real valid address, and and this how we can really identify the fraudulent transactions.
Okay, okay. But Vijay, your point, the big risk is actually at the user end where they lose the poor passwords, no multi-factor
Yeah, I mean,
authentication. Those are the bigger problems, really, is it?
yes, that is where a lot of this fraud starts actually. By having the right security mechanisms in the first place, and educating people about putting in place adequate checks, that actually safeguards a lot.
Okay.
And the thing with like we're talking about high value versus low value transactions. With high value transactions, everybody is comfortable playing extra safe, right? The bank will not hesitate in calling you up and double checking, and the volume is also low, right? So over there, people always or systems are always designed to play extra cautious, so it is easier to prevent frauds there. Larger volume of frauds happens with low value transactions, because over there, like people also look at the costs of putting in the extra checks and balances, and that's where it becomes more tricky. Unless it's a case of like somebody doing 1 paisa transactions at 5 transactions per second. I mean, that is very easy to catch
Easy to detect.
Right.
Okay.
But otherwise, a lot of these small value transactions pass through the detection mechanisms because of the combination of what would be the cost of putting in the extra checks, and a lot of times it is also very close to the usual behavior.
Okay, okay. Shilpa?
Yeah, there's some audience questions coming in. This is from Sunit Bose. How can or may AI ML affect quality assurance practices, especially in this industry?
Who wants to take that?
QA.
Yeah, I can take that.
Sure.
So with quality assurance, there are multiple aspects to it. So if you look at code coverage, when you're writing unit tests and whatnot, there was a paper that was published, I think a year or two ago, where they talked about a technique where you can look at the logs generated by a piece of, let's say you write a piece of program that does, let's say, transaction management, or it could be a simple or more complex system. So when you run your unit tests, the system will generate some logs. So you're trying to test a specific function of the system, a specific module of the system. And when you do that, so it will generate a bunch of logs. The system is going to capture those logs and keep that as a reference point. And when the system is actually being used or being tested by, let's say, your QA team, the system will look at those logs and compare A and B and see that did a new code point log a specific section which was not available as part of your unit tests. So that means that there is a coverage gap. So the system will be able to come back and say that, all right, so when a person is doing a transaction where the source account is this and destination account is this, then at that point, you don't have unit tests that are covering it. So this is one area where AI ML can be used, because this is basic pattern matching. You're trying to match a pattern from your time when the code was being built and unit tested versus when the code is being actually tested by a bunch of your QA team or your business team and so on. So this is one place where AI ML can definitely come into play. And there are tons of other places. For instance, there is code generation systems. Most recently, what you must have seen the capabilities where in GitHub, if you start to write a piece of code and just write a description in comment as to what you're trying to do, then the system will complete the rest of the code for you. You don't have to write the rest of it. So you will simply say that I'm trying to, so we'd say you create a function and say, this function is going to get like 3 or 4 different parameters. And inside that function, you will write a small comment describing what should happen with those parameters and those values. And you ask the system to, sort of fill the rest of the code. It will go ahead and do that. And in 1 or 2 iterations, you would have a very efficient bit of code that will just get generated. This way, you will make the developer's life easy and more efficient, because that code is actually generated by a system which has looked at thousands and thousands of other pieces of programs. Of course, that comes with a caveat, because the system may give you inefficient code at the same time. So you're going to have to do a bunch of reviews and stuff. So this is another area where AI ML can be used in coding. There is no code and low code solutions where instead of somebody writing a bunch of code, they would simply go ahead and create a flow or just drag and drop components into it, and that should provide for a much lesser turnaround in the code being written to being productionized. So the AI/ML is used in a lot of places. This is just some of them to list them.
Okay, interesting. I have a question for Vijay, but let me, before that, Uday, give me an idea. I mean, the large banks, the feeling is smaller companies like Vijay and the emerging ones, the fintechs, I mean, they are a lot more agile in using these newer technologies. The bigger ones are not so. What is your advice to the big banks? As the PSUs, of course, I mean, I don't know, they make it so difficult, some of these things. The private big banks seem a little more when it comes to accessing seamless operations and all of that. The private banks, big banks are a little better than the PSUs. What's your advice on big banks?
We have seen that, when we talk about banks, they are a highly regulated industry, each and every business, and they have a lot of compliance constraints. So, if they want to improve their innovation on some of the process, because having an innovation with an artificial intelligence, machine learning, it means that they need to change their processes. If they want to change the processes, they have to comply with all the compliances and the regulations. And this all is a very time-consuming job for a big banks. So, and on top of that, they have a lot of pressure for return of investments and profitability. So when you see the business side of the bank, they don't approve if there is a process change or if the long-term process change. They don't approve such type of funds to be invested from the technology innovation perspective. But comparatively for the fintechs, it's very easy for them to adapt to it because they do not have a lot of compliance and regulations compared to the banks. And plus, they are starting their business, so they have a lot of room for experimentation and going high on innovation and technology side. So this is one of the very biggest aspect. We have seen that banks tend to stay low on the innovation and machine learning perspective. And on top of that, banks has a larger business. They already has built their infrastructure, and their infrastructure is not coping up with the latest advancements in infrastructure and memory consumptions. So they need to upgrade their infrastructure. Upgrading their infrastructure has a lot of cost. And this leads to drag them off from bigger initiatives from the innovation perspective.
But the kind of things that the PSU banks do, I mean, at least some of them, I don't know if all of them, but two password, one password to enter the site, another password for transactions. I mean, it just makes it so difficult compared to the private large banks. So is that really necessary? How safe is it to do the way the private large banks do?
I think this is because these are two different individual systems operating in two different verticals. And these verticals are not collaborating with each other, and that's a bigger problem in big banks where they operate in a silos, and the silos are not collaborating with each other to have a seamless communication. But this is definitely and a scope for improvement for the banks where they can collaborate with each other, and the systems can connect to each other seamlessly to have a better customer experience.
Okay.
Another important perspective to have is it takes time for banks to implement a solution for various reasons. It could be the size, it could be the turnaround time, it could be funding, a whole bunch of stuff. But by the time something gets implemented, the technology world would have moved on. So by the time we implemented transaction-based passwords, OTP became the standard. So now the bank, which has invested X number of dollars or how many ever amount of money, now has to reinvest in a new, slightly different technology. So they would have a laundry list of things that they need to achieve. And this would kind of take a lower level in their priority list. So they'd probably get to it, but at a later time. So they would say that our system is secure enough. It may be a little more difficult for our customers to do a transaction, but we will get to it maybe next year or year after that or whatever, or after we do these 5 other things. So that is where you see these differences. And what Uday was saying about systems running as silos, that is absolutely true. your loan system is different to your insurance system. That's different to your transaction system. It's a unique complication.
Okay. Shilpa, otherwise there's a question for Vijay from the.
Yeah, sure.
No,
Go ahead,
go on.
Sujit.
Okay.
Go on, Sujit, go on.
No, he's asking, okay, at one level, it's an AI/ML question, I guess, but Vijay, we are booming with QR code payment systems now. What will be the next quick payment system you're working on? Is there some new things that AI/ML is making possible that will make it even more seamless and better than a QR code?
Yes, quite a few things. QR is nowhere near the final frontier that technology makes possible. And why only us? There are lots of innovative companies in India in fintech doing lots of great things. So there are voice-based payment systems being developed, being tested. There are biometrics-based payment systems. Right? There are tap based. Those are already reasonably popular, right? So you don't need to open an app and scan a QR. You just tap your phone and the payment happens. It's already quite mainstream. But yes, biometrics, voice, all those things are coming up. And QR at the end of the day is only a way of there being a picture and there being a scanner. That is only a way of exchanging information, right? As long as we can find more efficient ways of two systems talking to each other, we will have a better, more seamless payments mechanism.
Okay. That question was from Prashant Pohari. Okay. Shilpa?
Yeah, we have this question from Swarna Sriram. What is metric, or at what point do we decide if a model is a good model to deploy in say, fraud detection or loan processing? How much of decision making is currently 100% system based compared to system plus manual intervention, considering incorrect decisions could be a costly affair?
Mm-hmm. Who wants to take that?
So let me take that up. Yeah. So, I can say for myself that here what we do is we try to put as much of decision making as possible, which is very close to 100% in the hands of the system. So the real human intelligence goes into building the right systems. And fraud and risk is something where it is impossible for either a human or a machine to get things 100% correct. So one, we need to understand that. And therefore, the real benchmark for any automated system is not to achieve 100% accuracy or 100% effectiveness. It is to beat what a human-based system could achieve, right? And that goes for a lot of autonomous systems. Like we talk about, why just risk or why just frauds? We talk of autonomous cars, right? We have this very emotional view that if an autonomous car is involved in an accident, right, it's a bad thing. Yes, it's a bad thing, but when we talk of deploying systems on road, like letting autonomous cars be taken to the roads, what we really need to benchmark is like what is the crash rate, what is the accident rate compared to what is currently happening, right? Are autonomous cars safer than people driving cars? With people also we have lots of accidents, like people sleep behind the wheels. There are not enough like drivers who are not trained well enough, and all those things happen. Right? We will never achieve a state of 100% perfection, and that is not really what the benchmark also says. Right? What we achieve for is like, can we get to a state which is good enough?
Anant, you want to add to that?
Yeah, what Vijay talked about kind of is close to the trolley problem, right? How would a system behave in adverse conditions? And the decision making is actually tiered. So you would say that if a system comes up with a prediction saying that, okay, if somebody is applying for a loan, and that loan application, the system makes a decision saying that, okay, we should go ahead and approve this loan application or go ahead and give this loan. It also comes with a confidence score. So the system says, I am like 95% sure that this answer is correct, or I'm like 20% sure that this answer is correct. So based on the confidence score that has come through, and based on the model monitoring that has happened between the champion and challenger model, and based on all these things, some of these transactions can automatically be let through. about 95 to 98% of these transactions would automatically get processed with the system. Now, there are situations where the system is not confident enough about the answer, or situations where the expectation is kind of one of those corner cases where you never had this kind of a customer or never had this kind of a scenario that the system dealt with. So those kind of things would end up going to a human. So you need to have a combination of it. Yes, the goal would be to try and train a system well enough so that it can handle pretty much all of the incoming requests. But as in when you grow bigger and bigger, you will start experiencing or dealing with situations that are not so mundane or not so normal. You'll always try to find something or other which is different, and that's where these tiered approach comes into play, and that's what we help our clients build and design and deploy into that production environment. It's not the same. It's not one formula that fits all. Every situation requires something different, something unique, and that's where there is machine learning on top of machine learning. So that's what's called as a meta model, where a model that can train another model is actually built in dealing with these kinds of problems.
Okay. I have this question which I can relate to quite well. This is from Samshri Holi, saying a common use case in financial transactions, either on internet banking or UPI-based systems, is when the user's device loses connectivity midway through the transaction. This sometimes results in money getting debited from the user, but not reflecting on the other side. This causes panic and also locks up funds. Is there some tech solution to address this? I'm also sometimes scared. I mean, sometimes you're not sure whether it's gone or not, and it keeps saying processing. You're not very sure, never very sure what's going on. So, who wants to take that?
Yeah. There definitely are solutions to that. I mean, connectivity loss is a very, very common problem, right? And systems can be designed to take that into account. For example, like what happens in the way the credit cards and debit cards are processed. Is that the terminal on which the card is swiped, right? That terminal becomes the ultimate source of truth. So the transaction gets initiated there. The message gets sent to a lot of different entities, and finally the confirmation comes to the device, right? And the device has, like, we can call it, I'll try to avoid using very technical terms here. We can get some sort of an authorization token. Yes, this transaction has been authorized and you have this token, and you can claim this money by using this token, right? You can go to the bank and show this token and you can get the money, right? So the token comes to the device, and that is where the transaction is considered complete, right? And once the token has arrived, like the merchant knows, yes, the transaction is complete. The customer knows, yes, the transaction is complete. And if the connectivity breaks somewhere in between, let's say even after the banks have authorized the transaction, but the token has somehow not reached the device, right? So the bank may feel, okay, the transaction has been approved, but because the token has not reached the device, the money will never be claimed, right? And therefore there won't be that anxiety phase, right? And this manifests in, like, people would have seen credit card transactions don't reflect on bank statements real time. So this is the underlying reason, because they wait for the token to be claimed, right? That is one of the things that happens. So it is a more robust mechanism that has been implemented when it comes to card processing. Situation changes a bit when the two parties are not, like, at the same physical location. I mean, this is possible because both the parties are at the same physical location. The merchant and the customer, they are like in close physical proximity. So there can be one device which both of them can look at and deem the transaction to be done or not done. Things get more tricky when the parties are not at the same physical location. But still, I mean, there are ways and means. There are different levels of complexity. We can't be 100% sure in these cases. There will be certain, like, I mean, we can try to minimize situations where there will be this, like, debited but not credited kind of a scenario, but we can try to minimize these situations, right? But ultimately we can build a system where the money will either be transferred or it will not be transferred. I mean, that is something we can technologically guarantee.
Okay. Shilpa?
No more questions.
Almost out of time. Yeah. Anything that any of you want to final words, Uday? where is AI/ML going finally? I mean, what are some deadly new things that are likely to happen?
AI/ML, I mean, I still believe that, it's still the initial phase of it. So, the deadly things are yet to be coming from the AI/ML perspective. So every AI/ML solution has its own learning curve and maturity curve. And, we have not been to that curve yet. So most of the time we use AI as part of an assistance, and, less of a decision making unless it's narrowed down to some specific problems. So definitely, there's a long way to go when we talk about AI and machine learning.
Is use of cloud essential? Is use of cloud essential in this public cloud, or you can do it all in-house?
We have seen that, financial institutions are very reluctant to use a public cloud, but they have their own private version of the clouds. And they extensively use cloud computing for this, because that's the only way to scale the things up, when they need to.
Okay. Anant, any final words?
Yeah, on the cloud part. So there is another aspect where banks are, they kind of want to make sure that they hold on to the data themselves, the customer data and the transaction data and stuff. So they don't really want to go onto a cloud per se so easily. This is the kind of things that kind of hold them back. As a solution to that, most of the cloud providers, GCP, AWS, and others, they have a sort of a hybrid solution. Sort of a portion of their cloud setup can be done on-prem, another portion can be done on their cloud environment. These kind of solutions do help the banks to jump onto the cloud, but not really be on the cloud per se, right? They will get the benefits, best of both worlds, really. They will hold on to the data on their platform while getting the benefits of, let's say, quick deployment and monitoring capabilities of what's available in, say, GCP and AWS and others. So these are the kind of things that the banks are currently focused on when it comes to cloud solutions. And most of our clients are on private cloud for most of their transactions, except for things that don't really require a lot of customer data. So if you can build a solution based on inferences from existing models, then you can kind of take that onto the cloud. So there are some of them using AWS more on an evaluation level, not for production use, not for anything that would require regulatory compliance or regulatory monitoring.
Okay. Vijay, final thing, what's for you? What's the next big AI/ML solution emerging?
Lots of innovations happening in this space, so difficult to point to any one thing that is happening. I mean, fintech and finance in general is a huge space. There are lots of different aspects to it. What I am particularly passionate about is access. Right? How much can we leverage technology to provide banking and financial services to those who are not fortunate enough to be living in tier 1 cities, having access to bank branches and a lot of other things. How much can we do on the front of financial inclusion, right? That is what I am personally very, very passionate about. And
is there AI/ML can help there?
Quite a lot. Technology in general can help, AI/ML particularly can help. For example, like underwriting, right? By automating underwriting, we reduce the cost of underwriting. And that is what enables us to give a 25,000 rupee loan to a merchant sitting in a tier 3 town. Right? If we were to set up a physical branch there and collect all the documents for a 25,000 rupee loan, that would not make sense.
Okay.
So that's a very, very important aspect of how can leverage technology.
Okay. Wonderful. I mean, in so many areas, in financial inclusion, in fraud detection, reducing frauds, and speeding up transactions, numerous ways where AI/ML is really helping. Thanks for a great discussion. Thanks to Synechron for partnering with us. Anant, Uday, Vijay, thanks a lot.
Thank you.
Thank you, Sujit.
Yeah.
Thank you. Bye.